The bears are not loosening their grip following Monday's huge sell-offs, where the market lost 2.5% after the release of the September inflation data. The sentiments continue today as investors explore better yielding instruments to combat inflation. Olamofe Mathew, analyst at EDC Securities, joins me for more market updates. Olamofe, thank you for taking the time out to join us today. Let's get right to it. Let's start with the equities markets, and that at midday today we saw the market down over 2%. What is the investment play for investors as they digest the latest data from the MBS? I'm talking about the inflation for the month of September.
Okay, so for the equities markets, we've seen the market record strong gains initially at the start of the year. But following the question we've seen in recent times, we've seen market participants turn bearish in the equities markets. Market has given us some of the gains we've seen thus far. But what we know is as the major driver of the down seen at the start of the week has been majorly stocks like Airtel. We recall that Airtel has been a stock that investors have been using to repatriate funds, given the fact that it's been challenging getting their funds out of the Nigerian market. But currently, we've seen sell-offs in Airtel, given the fact that Airtel is a very large cap name that has wheeled down performance. But broadly speaking, market has been bearish, like you already mentioned, and that's largely due to the increase in use in the fixed income space. Also bearing in mind that, like you mentioned, inflation seems to persist for longer, and the outlook is that it's going to go higher. We saw the inflationary report for September came in at 20.77%. And then going forward, we're expecting that number higher than that. And so bear that in mind, it speaks to the possibility for use to fall increase. And that largely supports the sell-offs, informs the sell-offs we've seen in recent time. So market was down, okay.
Despite the sell-offs, since the beginning of the year and in the last year and a half or so, we've seen domestic investors hold forth at this market. We've seen them take a chance on the market in the absence of course, we saw that exit of foreign investors over, of course, reputation of funds, etc. But what do you say to how they've played this market so far? Contending with one, bearish economic data to the next, a weak economy, an election cycle, uncertainty with policies, etc. And yet, we have seen some strong gains.
Okay, so the strong gains you are alluding to, if I hear you correctly, came very early in the year. That was largely on the back of investors booking ahead of dividend yields, and saw stronger Q1 earnings received. But out of that era and beyond that era, we've seen local participants have been quite cautious as well. And if you look at the participation rates by locals in the markets, it speaks to the fact that sentiment seems to favor more investment in the fixed income market. We've seen locals to start to adopt cautious stance regarding equity instruments, and that's what we will expect to see going forward. And just like we've seen in recent times, market has been very volatile with a downward tilt, and that's what we'll see going forward. We expect local participants, especially PFAs, to start to look more into the fixed income space. It's go for. We don't see locals favoring. There are possibilities for bargain hunting, right? Investors who want to pick up stocks that, for instance, the GT touched 16 levels at some. That's why a good stock to buy for a PFA who's looking long, who's going to stay long. It's for the purpose of dividend yield, right?
Let's move over to the fixed income market, if you will. How investors also thinking of playing the market going forward, taking into account the government's increased borrowing plans going forward, funding that huge budget deficit. I know that obviously institutional investors will be positioning themselves. That on the one hand. Second question, the corporate bond market. Where does that leave the corporate bond market in terms of funding for corporates themselves, who obviously use the yields from the other end of the market as a benchmark for their own borrowing?
Okay, so for going forward, what we think investors are doing, playing short in the markets, because as you mentioned, yields are going to go further up, and so investors are trying to create liquidity. That's by the time it's licensed, they're able to position and make their kill. Just mentioned bonds used in the physical have been increasing, so we've seen investors playing short, and then they say by the time yields go up, furthermore, they are able to invest properly. But for corporate issuance, I mean, this is a period when they have to issue their instruments at something higher than this is no longer a COVID era where they were able to raise cheap funds. I mean, that's going to be more expensive. And that in itself, it means that we won't see so many corporate issuances in the markets like we saw in previous times because of expensive it is for them to raise funds in this era.
We have a few seconds left. What is your outlook for the fixed income market?
So for the fixed income market, we expect it to trend further higher. Trend higher going to the year. Even though we know that the DMO is trying to manage the cost of borrowing, but we think that they have there's little to what they can do to kind of curtail the uptrend. I will see you sticking higher go further into the year.
Right.
Especially on the back of and tight system liquidity.
All right. Thank you, Olamofe, for your time today. We appreciate it.